Good afternoon, everybody. Welcome to TraderMerlin Show for Wednesday. Happy Hump Day, everybody. A CPI announcement day, which actually surprised most people. I thought it would come out actually in line with expectations at 1.1. We came out significantly higher than that, which, of course, will make it the talk track for today's shows. Quick shout out to Margaret, Tomasina, Ron, up there in your 395 degrees. Love Vegas when it's in triple digits. Ugh, stay in the hotels, man, or stay in the AC. Lori as well, sweating it out in Phoenix. Good to see you, Doug. Les as well, starting things out. Bo Trader, Giselle, Eric. Got the whole group in here. Shiraj. I'm going to start things off just running through our top 7, and I want to talk about the CPI crisis. I kind of put that crisis in there because it's one of those, it's at levels we haven't seen for so long, but personally, I think that we see a reprieve coming. However, CPI is a rather lagging indicator and maybe a little bit delayed with regards to what it's presenting. We'll look at that, line it up with the charts, and give an idea of kind of what data it represents, and give us a forecast as to what might look forward to at the next CPI reading, which I think will be the big one. This one was obviously important. We also have PPI numbers coming out tomorrow, so we'll talk more about that as we progress. So let's dive right in. Good to see you, Ellen. Or you might be, I haven't seen too much Ellen there. We've got some new people. If you are new, hit that subscribe button. We do the show every day live at 2 p.m. Pacific time, unless I'm traveling or doing something else. All right. I'm going to start at the bottom, work my way up. Most of these market indexes had some decent volatility today, especially with the release of the CPI data coming out 1 hour before market open. Anybody who was trading pre-market had some nice whipsaw action and then some nice about-face moves. So let me start things off at the bottom here. Here's your Dow Jones Industrial Average finishing at 30,702, down 0.85%. No surprise, at least for me, that we're seeing it drift down a little bit more. Certainly the news that came out today does not paint a rosy picture for our market, right? It still is this big negative, negative landslide of news. We have all this bad stuff coming out. CPI now, all of a sudden, we're going to see headlines tonight and tomorrow morning saying, oh, inflation is much higher than expected. It's 9.1%. Okay, cool. I mean, let those headlines persist because that will cause people to sell, panic a little bit more. We will see as the show progresses that there was a fairly quick knee-jerk reaction in the futures market that changed the prospects for the 27th meeting. So July 27th FOMC meeting changed that perspective. All of a sudden, you guys might remember, a week ago there was no chance of a 1% increase. 4 days ago it was at like 3%. Yesterday it was at 9%. Today it's at 43%. I believe I'll check the current number here in just a second. But now all of a sudden saying maybe a full point like our neighbors to the north did. The Canadian market jumped a full percentage point as well. So I'll show you that data here in a sec, but I want to run through because that does paint a negative picture. So I expected this to kind of keep drifting down here. For me, it's kind of important as we've been looking at the implied strength that this small little pattern here has shown. I'm going to take this all the way up because I know Skilled Stocksman is going to get on me about it. But if you just look at this right here, all you can say from this picture is, you know, it looks weak because it's not as high as it was. Duh, that's basic stuff. But it's now starting to make higher lows, right? If we break these lows that we saw, a week ago, then all of a sudden the lows are going to be back in play, meaning we could see Dow below 30,000, getting to that 29 mark. And if those break, then you really have some big downside movement here. So Big Eb, who's I think you still might be holding some puts, Big Eb, or did you close those out? I was actually hoping would have rallied up more before I bought some more puts, but I did not. Anyway, Dow was down 0.82%. Nipping on the heels there was the S&P down 0.7% as we speak. And as you can see, pretty big volatile moves. You have these long topping tails and bottoming tails, which are indicative of a lot of volume. If I look at the range from the low to the high here, just to give you a perspective of what it looked like as it was moving. 3.22% swing intraday from high to low. So very volatile action, at least for the S&P, finishing at 37.97, so below that 3,800 mark I know a lot of you were checking out. NASDAQ down 0.38%, so not down very much, but huge swings out there. You also had Twitter posting some nice gains. I haven't been following that soap opera today because I've been busy with crypto and some other pieces, but not bad. I think Twitter certainly giving a vote of confidence to technology, which made it one of the better performers out there, even though it's only down 0.4. Right now, 0.41. Russell 2000 with the same basic picture, so I won't dwell on this one, but Russell 2000 down 0.35%. And then we move on to the positive stuff. Commodities looking pretty good today after our discussion yesterday about commodity prices with Scott McCormick, which thank you guys for the feedback. I love that one. It was actually just great having Scott on, and I'll try to get him on once a month because I know you guys love his content, but so do I. I put that stuff into my trading action as well. So here's gold. So on the session, it looks pretty much like what the indexes did, except gold finishing positive, up 0.52% on the day, even with those long volatile swings up and down. I'm going to get rid of this yellow box because to me that box is done. I'm going to leave the upper one there, but not too shabby with regards to price action, even though technically it doesn't really tell us much. There isn't anything here I find overwhelming like I should be making trades off this one. But if we do start to see gold rally back up, and let me put a line right here, and let's say it gets above 1750, well, now I might start to think. Doesn't mean I'm bullish on it, but at least I'm more bullish than I am right now. Certainly, another 17 points to the upside isn't out of reach, but I needed to start making some new highs here before I start thinking positive on gold. Now, if that inflation number, if the inflation panic keeps on precipitating, then that should help gold. Of course, we've got two factors here. You've got the inflation side of things, which most historic economists will say, if it's inflation, you should go to gold, or go to gold. It'll be a hedge. Well, it has not been for this inflationary cycle. So what do we look at? Do we look at the inflation numbers, or do we look at the dollar? Right now, I think the dollar is steering commodities, therefore steering gold. So we'll keep an eye on the dollar index. And if that dollar starts to tank a little bit, then I expect silver, gold, and these other commodities to shoot back up. And honestly, I think that they're long overdue for a nice little pop to the upside. All right, crude oil was also positive, especially after yesterday's gigantic sell-off from 105 all the way down to 96. Today, you had a nice little range. I mean, nothing compared to yesterday, but a pretty decent range, even though it closed almost unchanged at 0.63% gain at 96.44 per barrel for crude oil. Again, that line in the sand for me anyway is right around this 93.60 mark, which we kissed today. You can see the reason I put that line there before today, not after, was because of these points of contact here going back to March of 2022 as well as to April of 2022. So we kissed that one today. So for anybody who's looking to do a zone or confirmation entry might be coming, but buying off that demand zone might be a decent play, especially if we see this dollar drift down even more. Now, big leader day. Woohoo! Finally, some positive news. Bitcoin up 1.71%, but who really cares? Look at the price chart. It's just stuck in this sideways action. It's been for almost a month now, so really nothing interesting there. In my CIL, what we'll be focusing on tomorrow is the reason that could stop Bitcoin from falling would be a lack of liquidation from some of these lending protocols. You guys have heard so much in the news about Celsius and Voyager and BlockFi and Crypto.com. These are kind of the main culprits behind why you're seeing such an ugly downtrend in Bitcoin and cryptocurrency overall. So it'd be very interesting to see over the next coming weeks how Bitcoin stabilizes. If there is no more liquidation, then I would argue that the bottom is in for Bitcoin. However, I don't think we're out of the woods yet. There's still some shady stuff that I think has to come off the books from these firms, and we'll see that in the price chart. So right now, Bitcoin is nothing extraordinary, just kind of sideways action, 19,645. Now, the reason why I think you saw gold up today, this bad boy. We've been focusing on the dollar a lot. I think it's due for a pullback. It has not really had a decent pullback in quite some time. Now, today you had some volatile trading. You can see the pattern looks pretty much like the market's, just opposite, right? Dollar index was down 0.13%, had a decent range, long topping tail, bottoming tail, which does represent indecision. People really not knowing which way it's going to go. My assumption here, which we know what assuming can do, makes an ass out of you and me, is that this is going to drift back down here and probably test that 106.08 line that we have drawn on your screen here. It's just due for a logical pullback here. We'll see if I'm right or if I am absolutely wrong. Rod says, I'm loaded on Q and SPY puts, and put debit spreads and keep adding. All right. Well, I mean, Rod, you got to be careful though, because everything works until it doesn't, right? So as of the last 4 days or so, you've had some decent sell-off in the market, right? You can see these down moves, great, it's been doing well for you. But if we break above this 39.17 on the S&P or something, you have to figure out what your line is. I have it at 39.17, you could go slightly higher. But if all of a sudden we start to break above this and rip to new highs, you might want to dump those positions and lick your wounds before they turn into total losses, because you never know. Again, I mentioned this with Scott McCormick. It seems like everybody right now is over the top bearish on the markets. Now, let's look at the CPI numbers and data that came out today so we can, maybe paint a different picture of this market. Here is the numbers that came out for July 13th. As you can see up the top, that's the number that everyone is really concerned with, which is that CPI number. Previous number was a 1% gain. That's month over month, right? Well, the expectations were we were going to increase and get to 1.1. Came out at 1.3. Technically, that's a 30% increase in the inflation rate for month over month. That's a pretty substantial number. Now, I think most people are freaking out about that, thinking that inflation is this runaway freight train. And I don't think it's a runaway freight train. I think that there's some problems with inflation right now, and we'll look at the commodities in a second. But when you strip out food and energy, they expected it to actually drop from 0.6% to 0.5%. And lo and behold, we came out at 0.7%. So on pretty much all fronts, inflation is looking worse than expected. Now, keep in mind, this is not the July numbers. These are the June numbers, and they are at least 2 weeks late. So the numbers that's reported today was, let's say, 2 weeks ago. So that's the end of June. And in my opinion, that data is already collected maybe at midpoint June. So let's just say, hypothetically, and please type in the chat if you think I'm out of line here, that the data that you're seeing reported today on CPI, I'm going to say is 30 days old. So where would that put us in this cycle of plummeting commodities? So we talked about wheat. Let's go check out that wheat chart. If I go back 30 days, let's see, that would be, today is the 13th, so go back to 13th. That means that wheat, since that point, has dropped 24%. So I can't help but to believe that our next number is they're going to lower the expectations, because you can see on this page here that CPI right now, 1.3%. My guess is, and this is absolutely a guess, you guys let me know what you think. Type in your number if you think, what do you think the next CPI number will be, right? You've got 1.3% is the current number, which is inflated. My guess is they will say that the next number is going to be 1.1. They're going to drop it back down to this 1.1 level based off the same information that I'm seeing with just commodities. Now, check this out. Here is your CPI data. This is why I call it a crisis, because if you go back, and I should have gone back further, this only goes back to 2014, you notice that there's nothing on this chart before 2021 that looks even remotely bad, right? It's just normal fluctuations. And all of a sudden, we have these huge fluctuations in 2021. But the part that I notice is the expectations have been shattered the last 2 months, actually last 3 months, right? They definitely lowered their forecast for, I believe it was April. And now all of a sudden you're seeing it much, much higher. So, if we continue this trend, which is one of my mantras, right? The trend is your friend until the bend at the end. If this does continue, yeah, we're in a world of hurt. However, I think the commodities are going to bring this back down, and you'll see this number drift down, maybe back to 1.1%. But again, that's a month down the road. We have to wait for that data to come out. Now, remember, for anybody here who might be new to these markets, if you have CPI, which is Consumer Price Index, that's what we're looking at here, there's a cousin to that, or a brother or a sister, whatever you want to call it, where, again, it's the cost of goods produced is CPI. That's what we pay for those goods and services. PPI is what it costs to manufacture and make those goods and services. So there's what you and I pay and what it costs them to make. Here's why this is so important, because, again, I believe this is going to be a longer term play. If you look at that CPI chart I just brought up here, you can see that we as consumers are paying more and more and more, right? That's all this chart is showing. It's saying an inflation and a consumer price index, meaning the price for that basket of goods and services. But what about if we look at PPI? Notice that PPI for the past 2 months, while it has risen, it's not exceeding these previous highs. So you tell me, if manufacturers are getting their goods and services or producing this basket of goods and services, whether that's cars, televisions, food, whatever, if they're manufacturing that basket of goods and services and their costs are dropping, yet the consumer is paying more and more money for that same basket of goods and services, what happens here? How do you play this? I'm curious, how do you think you should play this if you can see that data that says consumers are continually paying more and more, but the producers are paying less and less? Not maybe it's less and less, but their costs aren't rising. To me, you have to put on two hats, and we talked about this with Scott McCormick. I personally do not believe that the vast majority of companies who have risen their prices 30, 40, 50% for you name it, McDonald's, Apple, cell phones, pens, clothing, all those prices have shot up significantly. If I'm a business owner and I have now got my customers, I see I'm making the same amount of sales, but my price has gone up 30% and you're still buying it, I have zero incentive to lower my price. So what I think this transpires into is earnings. Earnings down the road. Let's look at Q4 earnings this year. I think that Q4 earnings, especially for retailers of clothing, you've seen how much cotton has fallen, maybe General Mills, people aren't cutting back on their breakfast and cereals, we're still eating. Those profit margins could increase if those companies don't lower their prices. So, this is kind of the chess game I play in my head on a regular basis. I normally don't think that far ahead, like I'm not looking at years out. But I'll tell you what, if this does hold true, and producers, their prices start to decline, but consumers are continually paying more, that means great earnings for companies in Q3, Q4, and maybe even Q1 and 2 of next year. So just throwing that out there for what it's worth, random thoughts off the head of Crazy Merlin, but there you go. What's your take on the Fed rate hike on the 27th? 0.75 or 1%? That's a great question. So let's check it out. Let me bring up the Fed funds futures here. And here you go. 13 days, 20 hours, 42 minutes, and 41 seconds from right now. That's this announcement. Oh, wow. Holy cow, everybody. It really changed. When I looked at it this morning, this was 40%. So just so you guys can see, the last 24 hours, there was a 92% chance that we were going to see a 75 basis point increase. That's this blue number down here at the bottom I'm highlighting. Okay, I'll try to make this bigger. There you go. Yesterday, when we did the show with Scott, 92% of a 75 basis point increase, 7.6% chance of a full 1% increase, right? That's what it was yesterday. And notice that 1 week ago, there was no chance of 1%, right? Not 1%, not zero. But today, because of what happened with that CPI number, basically it was the butt puckering from the Fed, and most of the future traders were like, oh crap, they all of a sudden price in a 78% chance of a 1% increase next on the 27th. That's crazy. Personally, I think it's going to be 0.75. I really think it's going to be 0.75. But I love this because how often do you get to point the finger at someone and go, "You were so wrong. You completely screwed up." The Fed has admitted that they're screwing up without saying a word, right? Jerome Powell and all the FOMC members are not going to sit out there and go, "Fellow Americans, we screwed the pooch. We really, really messed up on this one. Sorry." They haven't done that, albeit Janet Yellen kind of said she messed up a little bit and read inflation wrong. How do we know that they screwed up? Because in September of last year, they said maybe 2 rate increases this year. First part of the year, we got 25 basis points. The next meeting was 50. The next meeting, it's 75, and now they're talking about 1%. So basically, they're ramping up this rate increase, which is a result of panic and realizing, we're in a worse position than we thought before. So to answer your question, Pepe, I don't think they're going to do a full point. I just don't see the need to panic that much. Remember, the 75 basis point increase that we saw at the previous FOMC meeting is going to take 6 to 9 months to filter through and hit the bottom line. You can't flick a light switch and inflation is cured, right? You can't, this is a horrible example. I hope this doesn't offend anybody, but like if you have cancer, you don't just take one pill and your cancer is gone that day, right? It's not instantly gone. It's a treatment. It's a process. You have to do it for months and months and months, and it's a grueling process. Well, I think similar situation for this financial market to get out of this is there's a process, but you don't just start tripling your dosage of rate increases just because things aren't ripping back to normal. It's gonna take time, so it will take quite a bit of time for this to get back to normal. I personally don't think you're gonna see a full 1 point. I think that was a knee-jerk reaction to the numbers. What we'll really be telling for everybody is what this number right here looks like tomorrow. So CPI is one thing. PPI is a whole different deal because the assumption is that if this number declines tomorrow, that means that the PPI number is probably going to drop going forward. And if that does drop, then there's really less pressure on the Fed to raise 1 full point. That's just my take from experience watching the Fed over the years. But really, the PPI number is critical tomorrow. I think that they're hand in hand important. It's like one's not better than the other. But if you look at the CPI, that was pretty ugly. We'll see what PPI can tell us about that and what the producers are making. So just my 2 cents. Honestly, Pepe, does it really matter what I think that the Fed's going to do? It really doesn't matter. It's kind of more on how you guys plan your specific trades. I was kind of shocked. I actually tweeted out this morning after the CPI numbers came out, and I was like, yesterday we had like a 7% chance or 8% chance. And now it's a 45%. And actually, as of this show right now, 78% chance that we're going to see a full point increase. Most of you probably have never seen a rate increase that big in your lifetime. It's been a long time. It's like Volcker days before we've had those kinds of increases. It's actually pretty crazy. Big Ed says, yep, I think inflation has peaked, but will remain high for years to come. Historically, when inflation remains over 5%, the S&P is about, I'm with you, Big Eb. I think you're absolutely right there. I don't think inflation is going to just be, it's fixed. Hey, we're good. We're back down to, $5 burgers. I don't think it's going to happen. I think it'll remain higher than expected for a while, but it's not going to crash back down to 2%, which is their target number. Mind you, we were just at 2% just a while back. The Fed was like, we're targeting 2%. We're at 1.75 right now, and just went straight up. So, I think that it'll be a challenge. I think that the Fed will not do 1 point just because it's too aggressive. They don't need to be that aggressive. If the Fed is doing their job, they have to be looking at those commodity prices that you and I have been looking at. And have you guys found it interesting? I don't know. You guys tell me. I'm sure a lot of you are watching different programs out there and following different influencers or market people. Has anybody really pointing out the commodity drop as much? I mean, to me, it's just astounding that I don't hear more mainstream media like hammering that point like, hey, commodities are tanking. Now, as Scott pointed out on yesterday's show, even though they're tanking right now, you look at that weekly picture or month, it's so weekly, we still are seeing that inflation rise up. It's definitely much higher than it's been historically. But this giant sell-off right here, right, that's part of the solution is watching this get fixed. And again, the blue line I have right here is just showing you the last month. The last month of prices for wheat. And let's do something like cotton, right? So look at this. It's not even priced in. If you go back 1 month, that's from July to June. Here's 1 month of wheat. It's dropped 65%, and that's not in the current CPI numbers, but it will be in the next one. So I think that what will happen is the Fed will raise 75 basis points, maybe even 50, but I think 75 is probably the smart bet. And then what they'll do is the next CPI number, then we'll get a clearer picture because I think it slows down the inflation numbers, but it's still going to stay rather high. I don't think that because cotton has sold off 65% in a month and a half, that it's dead. I mean, we're still going to use cotton. I can assure you that if the price of cotton goes negative like crude oil, I will buy every single thing that I could buy. I will mortgage every single property I have and put every cent in that commodity like corn, soybeans, gold, maybe not gold, but anything that, it's indispensable commodity. All right, sorry, I've been on a hell of a rant and I haven't gotten to your questions. My bad. Sorry, folks. You can tell when I get passionate and excited about things. It's fun. Merlin, what do you think of the energy stocks rebound? West Texas intermediate to 7, and I don't think too much about it. If I just basically follow CL, so I'm not following all the different derivatives and different oil pieces. But look at what happened here on the weekly chart. I think that we're due for a bounce. Right, I think you're going to see a little bit of a pop here, but nothing overly dramatic. I think that the last month and a half to 2 months really reflects just choppiness. Right, you've got this big fluctuations. For me, it's kind of this inflection point at 93.64, call it 93.50 on CL. That's the number I'm looking for, but I don't usually follow all the other oil products. Wheat has dropped, or wheat futures. It's affecting farmers for food manufacturing already. Well, I'm not sure about that. That's why I really want to get somebody like Don Dawson on. Don Dawson knows that intimately. I can just follow the price of the futures products, but I'm not sure what's the timeline for the futures and delivery, and how long does it take for that to hit the bottom line? It's a great question, Tom. Unfortunately, that's not, I don't know that. I'd love to know that. So if somebody knows, hey, Alpha, good to see you. If somebody does know, please feel free to share it with us. But I'm sure it'll take some time. Just like, these FOMC announcements, It always cracks me up because people think that it's, again, instantly going to hit the market, and all of a sudden businesses feel it immediately. No, this is a slow it's going to take time to let all those FOMC rate increases that we've seen hit the market. Technically, the one we had back in the first part of the year, the 25 basis points, is just starting to filter into the market. All right, what else do I got? We will know tomorrow what PPI is not making a new high until tomorrow. That's right, we won't know. Just an expectation. Gallo says they're taking advantage of the consumer while they can. Don't they always? Right? I forget the manufacturer. It might have been like Louis Vuitton. I read somewhere their handbags were like, $1,000, and now they're like $4,000 for the same bag. And they asked the CEO, like, why are you guys raising your prices? And he just goes, because people are paying it. Like, that's the problem. Keep raising your prices. We have to have the voice. I told you my story about going to Taco Mesa. I feel bad because I love Taco Mesa here in Costa Mesa. But I was like, you're going to charge me $17 for a burrito that a year ago was $8? I'm not supporting that. And that's where we make our voices heard. And ultimately what will happen if more people stop buying those items, prices will drop. I went and bought, my girlfriend, when she came to California, bought a Toyota 4Runner. And we were looking at used Toyota 4Runners. $39,000 what they wanted for a used Toyota 4Runner. That's crazy. We went into the showroom and the price was $41,000. So I said, okay, we'll take that one for $41,000, brand new, TRD Pro 4x4. I go, yeah, well, it's going to be $7,000 to $10,000 over sticker. What? Because they can't get them. So they're just, they're gouging consumers because they can. It'll end when you and I stop buying this stuff. All right, let me see. Could they go higher, 1.25? Well, anything's possible, Michael. And we'll have to watch this tomorrow. But like, if the PPI number, right? Here's the chart of PPI. So the PPI number was 0.8%. So 0.8% increase per month. If you times that by 12, which is what this number is, then you would get what the annual rate is. So let's just assume that the last that it's going to be nothing but 0.8 going forward. So 0.8 times 12. That would give you an inflation rate of 9.6%, right? Obviously, what it's doing is it's taking the last 12 numbers and adding those together. That gives you what your inflation rate is. If tomorrow we see this PPI number, and again, this is not going to happen, but hypothetically, if the PPI number came out at, let's say, 1.6, like doubled, and it was well above expectations, then what you would see is this right here would shift again. And it might actually price in $1.25 or 1.25% increase, right? But I don't think that there's enough need for fear. Like if we saw commodity prices, well, let me just paint a different picture for everybody here. Let's just say, here's crude oil. And crude oil has been having an aggressive sell-off, right? You look at the price of oil and it's down, call it 24% in 19 trading sessions. That's in 1 month, it's down 24%, which tells me that this is not in the PPI or the CPI calculation, nor will it be in the PPI calculation. Now, what if the CPI number came out today and the chart looked like this? You guys can see how different that would be, right? Because at this point, the FOMC members can look at this and go, oh God, it's still on an aggressive uptrend and it beat expectations. And they know it's a lagging indicator. Right? So they would look at this and be like, oh, this might cause them to raise 1 point or 1.25, no problem. But because it looks like this, I think we're going to be seeing a little bit of calm because we've seen that big sell-off. I know I'm beleaguering the point. I apologize if I keep going over it, but I'm just going through your questions and checking stuff out. All right, let me see what I got down at the bottom. I did an Instacart yesterday, and my rotisserie chicken was $18. NJ, I will deliver it to you. Holy cow, yeah. It's a sad day when we have to talk about the cost of inflation, and I want everybody to shed tears here, but Costco has increased their prices due to inflation. I know. It's incredible. But they're keeping the Pepsi and Pepsi and a hot dog for $1.50. God bless In-N-Out, or not In-N-Out, Costco. It's the chicken crunch wrap went from $2.99 to $3.99 and a couple other items, but even Costco is feeling the pinch. All right, I'd be an analyst for a specific industry and get real costs. I don't trust CPI. I agree with you, Margaret, 100%. One day I would love to have somebody on from CPI, from the BLS or whoever puts together the CPI numbers and really understand at a deep dive what exactly data they are using. Again, I don't trust it, but I would ask the question to them this. Let's say you're using a quart of orange juice as one of the measurements for PPI or CPI, right? A quart of orange juice. Well, my understanding is a quart of orange juice used to be 64 ounces. Or no, that's a half gallon. Now they're 58. Now you're seeing Pringles in those tall cans. It's shorter. They're removing space, right? It's shrinkflation. So I would love to see exactly how they calculate that in. If I buy a 6-pack of beer that used to have 6 12-ounce bottles, but now it's 6 11.2-ounce bottles, and that 6-pack has stayed the same price, is that considered inflation? In my mind, it is. BLER, B-L-E-R, Bureau of Labor Statistics. It's the BLS, Bureau of Labor Statistics, is one I think. That's the jobs report. There's so many freaking bureaus out there. It drives me nuts. Groceries here in California are wild. Absolutely. It's funny. Eating at home used to be like you'd save a lot of money. Now I'm eating at home going, man, this is exactly what I used to pay going to the restaurants, a year ago. It definitely has changed. So bizarre. All right. So that's what I wanted to get into for the CPI. I called it a crisis because on paper, it looks like one. When we look at these charts, this looks like a crisis. This looks like a 1980s type situation where it's just surging up. But I think we're going to start leveling off here. I think this number, and not this one, not the July number, but probably the August will show a slight pause. I think that the September one will have a bigger decline in CPI numbers, and the market will calm down a little bit, which may lead into a nice rally near the year end. But we'll have to wait and see when we get to that point. So that's my CPI crisis picture there. Again, I don't really necessarily feel it's a crisis. I just think that everyone's freaking out about inflation, and I think we're going to start to turn the corner. What's my thought on gold? So I'm long gold in full disclosure, so physical gold. I don't have any ETFs or anything. I'm actually long silver as well. Gold looks terrible right now. Gold looks one of those ones, like one of those charts where you just go, God, I just want to short it, right? And wait for a rally up to 1800 to short this thing. We've got those 2 downward trending lines that we've drawn. Again, those are different perspectives of where to draw trend lines on. One of the viewers said, I like the blue one. I use the red one. Either way, it doesn't matter. They're both saying it's trending down, right? So I'm bullish long term. When I say long term, I mean like years on gold, right? And in the next few months, it does look weaker. And again, if this dollar does not turn around, then gold's going to continue to fall. If the dollar has a pullback, which I believe it will, it's just due for one, honestly. It's long overdue for a decent pullback. I mean, the last time it actually sold off was mid-June, and it didn't really sell off that much. We haven't really had a down day. I mean, look at how crazy this is. There's been there are red candles, but they're not down days. There's 1 down day, 2 down days, 3 down days in the past, 3 weeks? I mean, that's a pretty substantial rally up. And again, we know the cause or part of the cause for that move to the upside. So I think if we continue to see this trend happen in the dollar, then stay short gold. I hate to say it because I own gold coins, but at some point it'll be an attractive buy. Now the other piece here is where might gold start to bounce. Look at where we hit at today. There is not any real relevance to that zone. So I don't know. Some people are saying, it hit a demand zone. I didn't see a demand zone get hit today. What I'm more interested in is this kind of double tap that we saw back here in March. March 5th and March 30th, you had a kind of a double tap right around 1670, which is almost the low point from this low back on August of 2021, which is also the area of consolidation, the base going back into 2020. So that to me becomes the really big number. For anybody out there who is optimistic and would like to buy gold, you could do something like this. Bring up GLD. All right, there's your, it's on snap mode. There's our level right there. Maybe you sell the 157s on GLD. Right, because that's the logical point for it to be drawn to, like a magnet, like a Ouija board. It'll come right down to that level, and you might be able to collect some premium over the next couple weeks if in case it gets there. If it doesn't, well, you collected some premium. So, Alexander, that's kind of how I would play gold right now. I don't know if I would jump on gold futures, but I might be selling some puts on GLD, maybe at that 157 strike price. I'll look at that tomorrow because actually I think that might be a decent play going forward. Collect myself, a 1% or 1.5% for the month. Let's do it. Think, would inflation be an issue if you're If our wages were in accordance, with our wages, not quite sure I understand that one, Fink. When we look at personal income, so let me bring up Forex Factory here just so we can look at personal income. Those numbers haven't really been showing an increase. So we've seen prices increase, but income not. So let me real quickly just run some filters here for everybody. We'll put none. We'll put USD. We will do none. And I'm looking at employment data. So that growth, we'll do growth. Consumer surveys. I think that should do it. We get earnings from that. So let me go calendar here. Oh, dab nabbit. Bear with me. I just want to see. I want to see the exact data. I'll take housing out of there. Take speeches and bonds and central banks out. Let's see what we get. So there's personal income and personal spending are two regular announcements that can kind of paint that picture. And they came out 2 weeks ago, I think. Yeah, I believe they were 2 weeks ago. So where's personal income and spending? There you go. So you can see that personal income hasn't increased. It's been staying at 0.5%. And here is your personal income chart. Now let me just zoom in to get rid of the COVID stuff. But personal income has been staying the same. So the money coming in staying the same. But over that same period, what has been happening to prices? They've been absolutely surging, right? So to me, this creates a bigger problem because people aren't making the money to afford this, right? You guys can see, let me real quickly, this goes back to July of 2021. So July of 2021 is going to be right about here, right? So where I have that red line, you can see that tremendous increase in the inflation numbers. But if you look at here, it's showing the same data, but this is income. Income is just flatlined. So obviously this is going to impact consumer. This means that people can't buy those goods and services, which does what? That potentially puts us more in a recession because we can't buy that stuff. What it may also mean is it's going to put more people into credit situations. Now you look at personal spending, which is this next line item, and I'll zoom into that same period of time. It was July of 21. There we go. Spending is also declining. So now we're starting to see the impacts of it. Hopefully, and I really do say this lovingly, but hopefully everyone is realizing that I'm not making more money, but everything is increasing. So what should you do? You should stop buying stuff. And I think that that's what's reflected here. Personal spending has been declining significantly since this February high. Good. Save your money, right? You might go to the store and go, oh, I really want this. And you go, you know what? I don't really need it. I'll wait. And wait going forward. I mean, if our wages were increasing at the rate of inflation. Oh, if our rate of that's exactly what I was just pointing out right here, Fink. If this chart here, which is personal income, looked like this, right, to the right of this red vertical line, then we would probably be in a completely different situation. We would have potentially hyperinflation, I think. Because now you have people with the money to chase these prices and it would pay more and more and more and more. And then we'd really be in a bad situation. Remember, John O'Donnell loves saying, what is the cure for a high price? It's a high price. The more that price increases, the more likely people are going to stop buying it. Unless they have more and more money to buy those goods and services. And what this data is showing us is they don't. They do not have the money to buy those goods and services. So, I don't know what this all means going forward. It's just these are the facts, right? The facts that are presented to us from the government agencies. Again, got to trust all those ones. But that is what I'm looking for here going forward. And I think that tomorrow's number is going to be critical in determining what the Fed's going to do on the 27th, period. What would a stagflation look like? How do we get there? Well, we're almost there. So let me go back and show you a little bit more data. So there's three main components to a stagflation economy, which we've talked about in the past before. Number one is declining GDP. And basically, we have it, right? You have GDP is now contracted. We've had 2 consecutive quarters of GDP decline. So that number one box is checked. You've got declining economic growth. Number two is going to be inflation. Well, we've got it. I can show you that chart right here. Here is the inflation. And it's elevated significantly. So those two check boxes marked off for stagflation. The third one, and the one that is still looming, is the number that we saw. Let's see, this is July, I think last Friday. There you go. Is this chart. Unemployment rate. So the third component of stagflation would be elevated unemployment, and we do not have that. However, if I zoom in here, notice that it's flatlined, but the expectation has actually been increasing. They're expecting to have higher unemployment, and I think that the next number we're going to see for August will be above 3.6. Now, I would not say this is elevated in any way, shape, or form, but if it does start to curl, it could represent the bend at the end, which I lovingly use all the time on this show, and you're probably sick of it. The trend is your friend till the bend at the end. And look at unemployment. Since 2020's high, we were up over 10%. Now we're at 3.6, flatlining. How much lower can it go? Really can't go to zero because you're going to have people that just don't participate. But if this starts to curl up, then the argument is we may be in a stagflation type of environment. Now, in my opinion, for it to really be a stagflation environment, you'd have to see a significant increase and have to happen rather quickly. Could that happen? Sure. If companies if you get the domino effect of what we're seeing, which is you have elevated inflation numbers and no money to the income is not in line with that, meaning consumers can't afford those goods and services, which means consumers stop spending. And we looked at the consumer spending numbers and what? They are selling off. We're seeing lower consumer spending data. So we're already seeing that trend. If consumers spend less, then what happens to the retail companies? What happens to your Ross stores, your McDonald's, Walmart, JCPenney? Well, JCPenney is already dead. Toyota. You're going to buy less because you don't have the money unless you're dumb and put it all in credit cards and put yourself into bankruptcy. Don't do that. So that means that those companies are going to start to feel the pinch and their earnings are going to start to slide, and they're going to do what? They'll start to do layoffs. So it could happen rather quick. Robert says, how do you factor COVID? I don't know. I think COVID is definitely a much more muted impact. I don't think we'll get back to the point of mass hysteria like we were back in 2020. Certainly, there's obviously dangers to COVID, and especially if you have a compromised immune system or you're not taking care of yourself, eat right, exercise, try to reduce your stress, and be careful about what you're touching in big crowded groups. I mean, that's the easiest way to take care of yourself with regards to COVID. Do I think it's going to have a huge impact on the economy going forward? I don't. I think that, at least I'm out here in California, most of us are kind of like, okay, I've had it. It's bad. It's not that bad. Even though I was as careful as I could possibly be wearing masks and everything, I don't think it's a piece that'll bring down the markets like we saw back in 2020. A slight impact on the market, but I don't really think it's that big of a deal. Oh, hope you're feeling better, Patrick. First time I had it was a good 14 days. It was 2 weeks. So that one was the rough one. The second time was less than a week, and it was mild symptoms, high fever and achy pains, but that was pretty much it. No problem. I'm with you. The second time I actually didn't lose my taste or smell, but I tested positive apparently. The first time was weird. When you lose your sense of taste and smell, it's just kind of awkward. COVID way of life, as long bats in China. I don't know if it was bats in China. We won't go to the conspiracy theories about how it was created. What's your take on stagflation? What exactly is it? Have you lived through it before? There was some in the 70s, so I've lived through it technically, but I don't know the remedy for it. And again, that's one, I think when you look at depressions and recessions, there's a way out of a depression. It's a simple math equation, right? You can modify things until the results hit. But the challenge with the stagflation is if you fix one problem, you make another problem worse. For example, as I ran through those three things, do I fear monkeypox? No, I don't fear monkeypox. Look, I'm not going to live my life. Look. If COVID had a mortality rate of 50%, I'm not leaving my house. I'm not going anywhere. But in my age bracket, it was like 0.01% mortality rate. I'll take it. I'll get it, right? Now, I may not be the healthiest person on the planet, but I do exercise regularly. I try to eat healthy, and I try to do things to reduce my stress. Study some languages, go out and run, and travel or play some music and different things like that to reduce my stress. Go play with my dog, that type of stuff. But I don't fear it. I don't fear no monkeypox. Try not to live our life in fear. But again, if it had a high mortality rate, I'd be a different story. I think Merlin got COVID from those Wuhan e-bikes. No, I got it. First one I actually know exactly where I got it. I got it at a Fish concert on Halloween in 2020 or 2021. Excuse me. Clear as day, know where I got it. And then the second one was actually San Diego. I went to a country concert. So concerts, bad news. Wear your mask. Don't touch anything. Why do you not day trade as much anymore? Time. Time is my critical thing. I do this show every day from 2 to 3. Obviously, it takes time to prep and get ready for the show. So, a 30-minute program is now taking me 2 hours to do every single day out of my day. Plus, I'm also building content for Online Trading Academy, and I'm teaching cryptocurrency courses for Online Trading Academy, as well as producing all sorts of video content for them. So, I'm busy. I'm real busy. If I didn't have, if I wasn't working for Online Trading Academy, I'd probably do day trading a lot more. A lot more. I enjoy it. I really enjoy day trading. It's a challenge, right? It's really hard. For those that day trade, you realize it's stressful. There are some challenges to it. And if you can't handle those stresses, you're probably going to end up losing overall. Bob Dunn, not a big fan of day trading. Why? Because I think he knows the statistics. The statistics are that most people fail at day trading. They'll end up churning their account. They're making too many trades, using small time frames. They get stopped out all the time. Take a step back. Look at the bigger picture. Do set and forget orders. It's just less stress. All right. Let me go to a couple questions here before we dive deeper into it. I didn't actually finish your question, did I? I think I did, Frank. Did I get to your stagflation one? Can we have the ambassador of opportunity in the show? Yeah, I'll get him back here. I would love to get him back on the. I'd love to get him back in the program. Tom says, until 15 years ago, tipping was, oh God, that is ridiculous. Like, it's funny. You go to places and here's the new scam, everybody. Pay attention to this one. And it is a scam. You'll go to a lot of restaurants and it'll say on the menu that the tip is already calculated in at 18%. And then you get the check and it says, would you like to tip? It's like, you already put it in the bill. And now you're asking if you want to tip on top. That's the good scam that comes out regularly at restaurants. So Frank, as far as stagflation, let's just use the simple example. You have those three components, right? Which is declining economic growth, you have high inflation, and then you have, on the other side, rising unemployment, right? So GDP down, unemployment up, and inflation up. If you have unemployment surging, right? Goes from 3.6, and it's 4.6, 5.6, and all of a sudden starts to surge. What do? You need to flood the market with money so that companies will expand their businesses, and you need to make money cheap. So you need to cut rates and issue stimulus, which increases the money supply. And what does that do to inflation? That causes it to surge even more. So you can't do that. Now, let's say inflation keeps going up. It's 9.1 today. It's 10.1 next month. It's 13.2. And you're like, hey, let's fight that. Let's get inflation under control. So what do? Well, you would remove money supply by selling the bond products, which the Fed is doing. And you would also raise interest rates. But if you raise interest rates, you start to hurt the employment numbers again. And you could create a surge in unemployment because raising the interest rates increases the cost of capital. So you see, it's a damned if you do, damned if you don't scenario. So that's why stagflation is so dangerous. What's the solution? I don't know. Okay. Let's go. I want to get to this listener question before I wrap things up because Eric, I told you I'd get to this today. Eric says, I have a fair amount of money that I want to invest long the S&P. One sec. I need to yell to my Great Dane to be quiet. I don't want to blow your eardrums. So hold on 1 second. There you go. Hopefully you didn't hear that one. Okay. Kate Irwin. She's damn hot. Yes, she is. And smart too. Okay, so Eric says, I have a fair amount of money that I want to invest long in the S&P and NASDAQ. Once it turns, I have no emotional need to catch it at the bottom. I see three options. Option number one, buy a decent amount now and then continue to buy and dollar cost average as it goes down. So certainly that is one approach, right? I think, and this is the same situation. I have a bunch of friends keep asking me, when's it time to buy? When's it time to buy? I said, I can't tell you that. It's up to you. So if you thought that, hey, market's down 20%, I'm in it for the long haul, I'd like to buy some right now, great. You could buy some of, and I wouldn't buy individual securities, I would probably buy indexes a little bit safer. And then if it does continue down, you could dollar cost average. Great, that's one approach. So let's run through all three and we'll do a critique of them. Option number 2, pick a price point that is above the confirmed uptrend, then keep moving the price point as it continues to drop. So I'm not quite sure on this one, Eric. You said pick a price point that is above the confirmed uptrend. Well, if markets are selling down, then we're in a confirmed downtrend. So I think number 2, if I'm not mistaken, is almost like number 1 here. It's a dollar cost averaging. Number 3, use options with the potential of being assigned at a lower price and collect premium, and then after it turns, apply option 2 for the remaining funds. What's best? Personally, if you're asking what my strategy would be, it would be option number 3. Now let's just say, for example, let's bring up some charts here and look at the SPY, right? SPY. And you go, okay, I want to go long the market, and I'm a long-term investor, so I want to deploy capital for the longer term. Great. And you go, okay, well, where's the big potential drop point here? Well, if you want to buy some right now, you could sell put options today at the money. So do a 380 put option. If you said, I'd like to buy today, I'm happy owning the SPY at 380, great. If you sold put options right now at 380, you'd collect some serious premium. You could collect a ton of premium. The second piece would be, all right, once that's done, maybe you pick some other levels. Maybe it's this 332 or some other level here that you've discerned. Let me go maybe to a weekly because I can see some levels. And start selling options at those specific points. And if you don't get it, okay, so what? You've collected premium. That's what I do myself and what I think we would do or would be the best option here. Dollar cost averaging is dangerous because if it keeps on falling, you could get to the point where you might get a margin call depending if you're using leverage or not. Don't worry, hombre, I will get to your Nvidia or Indian markets. Yeah, stop spamming Avadhut. Don't spam me or I'll block you. I'll get to your question. I think, Eric, that your number 3 is the best choice, but that's my personal preference. It's saying, look, I don't know if it's going to keep dropping. If it does, I'm happy to buy it at these lower prices. I'll be selling options and collecting premium. If it turns and starts to rally, then you can always buy in. That's fine. But I would, sell some at-the-money calls right now if you're happy buying at these levels and keep selling. Selling those puts, collect premium. Right now, puts getting some good money. You get some good premium as this market starts to sell off. So that's how I would approach it, Eric. I think that your option number 3 would be the best. You could buy some right now to deploy more capital, but you can get some pretty significant premium on at-the-money options for SPY. I mean, just do them weekly, right? If you don't want to be that active, do them monthly, right? I do them every month. So I do pretty much 30 days out is where I will be selling my options and getting between 1 to 1.5, maybe 2%. It's not huge rate of return. But if the market keeps falling and I'm getting 2%, great. So there you go. All right. Avadahut, who asked 4 times in a period of 27.7 seconds, what will the CPI effect tomorrow morning be on the Indian markets? I have no idea. I don't trade the Indian markets. I really don't trade much to international markets unless I'm buying like an ETF for those specific markets. I don't know the data behind India. So if you are looking at trading the Nifty or some Indian market, you need to look at that internal data. Most of the time, the data I'm looking at here is going to be for the US, Canada, Europe, British pound, Japan. I don't really look at the Indian markets too much, but it's the same basic process, right? You're looking for the trends of the data within your country. So if you see that India, or maybe if it's done by province, has rising inflation significantly, then you have to ask yourself, well, what is my central bank doing to fight this? If they're being really aggressive, then you can start to formulate a plan. If they're being lackadaisical about it and just saying, oh, let it go like Europe is, formulate a plan against that. So I don't know. I can't answer that question for you, unfortunately. I have a big quantity in the index CE for tomorrow. Well, my guess is you're probably going to see, because the U.S. markets are the driver for global economies. It sounds arrogant, but that's just the way that it is right now. Yeah, Margaret, I'll have the answer for you in 24 hours. Most likely. Today wasn't a bad day. I mean, if you look at the equity markets, S&P down a little bit, NASDAQ down a little bit, Russell, this really wasn't a bad day considering the inflation numbers. Right? I think people were anticipating it. So what will probably happen is your market, if we had a crash day, let's say the U.S. markets were down 5% today because of this, then India markets are going to get slaughtered on the open. My guess is you're probably going to open down a little bit, just in sympathy with the U.S. equity markets, but I really don't think it's that big of a deal. I think that you're going to see a non-event tomorrow for Europe. Told you, be ready for the gap down. Yeah, but I don't think it's going to be big. I think it'll be a small one. Yeah, Brandon Wendell, if you follow Brandon Wendell, which is at TraderBW on Twitter, he looks at India a lot. He lived over there for a little bit, so he's much more into those markets. So, all right, I got to wrap things up. I know, Big Eb, you're just salivating over the 1 hour show. Let me see here, because Les, you asked this one. Oh, KF, I got 2 questions. Damn it. Do you know about BitGet, crypto exchange? Are they legit? Look, they're out of Singapore. They claim to be really big in the futures side of things. I think, me personally, KF, I'm not going to be doing much outside the U.S. Now, I do have a KuCoin account. I got a couple of international ones, but I do think that it's dangerous to trade with brokerage firms that are out of your country. And guess, you think Singapore is safe. Well, Three Arrows Capital was from Singapore, right? And they're the one who caused trillions of dollars of erosion of capital out of crypto. So just because they're in Singapore doesn't mean that they're safe, even though Singapore government can be pretty strict. I don't know BitGet. I haven't seen any really bad complaints, although I'll be honest, I've never heard of them. I literally have never heard of them. So I don't know. If you do use them, use a little bit of money, and I would just kind of keep an eye on what they do, how they generate their revenue, right? If you look at things like Celsius and Voyager, etc., they were out lending to some shady characters with no collateral. I wish I knew that up front. We're not getting it, Big Eb. Don't even think about it. Not going to happen. Let's see. Last one. This is from Les, who is probably still here today. If I was trading the NASDAQ, I might look at XLK sector to see how the sector is doing. What sector or sectors would I look at to give an indication of how the rut is doing? The only thing that I would know there is going to be just the IWM, but that's the whole index, right? When you look at what Russell represents just small cap companies, right? So there's so many. It's not saying that they're technology or banking or anything like that. It's just everything that's small cap. Where if you look at NASDAQ, it's predominantly tech companies and biotechnology. So you kind of still have, you can break that apart by saying, let's check out biotech, so let's check out technology. But the Russell, I don't really see any fragment of small cap. It's just kind of lumped into one bucket. So unfortunately, Les, I don't have anywhere to point you there. IWM is really it, but it's just a proxy. It really is just a proxy for the overall Russell 2000 index. You use IWM as the ETF or the RUT futures. Not going to happen, Tom. And just like that, I've got 2 minutes left. All right. What is today? Today's Wednesday, which means Thursday we've got how about your economic calendar? You think you're going to get it. You're not going to get an hour show. It's not going to happen. Here is your calendar for tomorrow. Economic calendar-wise, you can see we've got PPI numbers. That's the one everyone's watching out for. I do actually have some China data on here, but who trusts the data coming from China? That would not be me. And then you have tomorrow earnings calendar stuff. Let's see, did I update it? I didn't even update the earnings calendar. I'm slacking in my old age here. So with earnings tomorrow, you have the kickoff to monster potential news, and that is going to be the banking sector. Tomorrow, we have some major names coming out. Here it is. Morgan Stanley, JP Morgan, ConAgra Brands, Taiwan Semiconductor, Cintas, and Ericsson, and that's just the start. We have even more happening on Friday's session. So that's what's going on Thursday. All right, everybody, that's going to do it for me. I want to give you guys satisfaction of an hour show. So thank you so much. If you have comments, questions, feedback, let me know. Email me at TraderMerlin@gmail.com or put them down underneath the YouTube videos, and I will see everybody on our Thursday show. Take care, everybody.